The market keeps grinding up to new highs. And predictably, the AI bubble whispers are now getting louder. The Magnificent Seven stocks now represent 32% of the entire market, or roughly one third. At the same time, this group of seven tech powerhouse companies are plowing colossal sums into AI development. Apple, Microsoft, Amazon, Google, Tesla, Meta, Nvidia. These are all extremely profitable businesses that are using their own cash flows to invest into the build out of all this AI infrastructure. But the bottom line is that the valuations for these companies, these AI high growth companies, has never been so high. The expectations are simply enormous. At the start of this week, Meta and Alphabet, Google's parent company, were trading at a multiple of earnings of 25. Amazon is at a PE of 33. Apple and Microsoft are at 37. Nvidia is at 52. And Tesla is at 289. The forward PE ratio for this group of Magnificent Seven stocks is now a 30, which is way above the broader S&P 500s. But even when we look at just the S&P 500, it's at a historical high. The only times it has been this high this century are in 2021 and in 2000. Famously, these are the two periods that you could call a bubble of the past 25 years. When the PE multiple is this high, it is usually followed by a correction, a re-rating that leads to a 40 to 50% drop in the market. Given the amount of high valuations that are flying around, the concentration of the S&P 500 into the Magnificent 7, and the general optimism felt by investors, some critics are starting to compare this market, today's market, to the Nifty 50 market of the 1970s. It all begins after World War II, a very prosperous period for America and American companies. Among investment managers of the time, a new buzzword appears: one decision stocks. These were companies so good that there was only ever one decision to make: buy. One decision stocks were a group of 50 different companies. They were all blue chip, they were all high growth, and they all represented American culture of the time. A lot of the companies in that basket still exist and still thrive today. But among that group were also companies that didn't fare so well, especially technology companies like Kodak, Polaroid, and Xerox. The average PE multiple for the broader market in the early 70s was a perfectly respectable 15. In other words, you pay $15 of stock and you get $1 in annual earnings in return. That's a 7% yield, and it's pretty respectable. But the never sell mantra around this Nifty 50 stocks pushed the valuations of these companies into fantasy land. Investors were just willing to pay any price to own a piece of American greatness. For example, Disney sold at 71 PE ratio, McDonald's traded at a 86 PE ratio, and worst of all, Polaroid traded for a 90 PE ratio. At those prices, investors were effectively accepting a return of 1%. And it didn't just stop there. At their peak, the top 5 companies of the Nifty 50 represented a quarter of the S&P 500. The full basket of 50 companies represented 50% of the entire S&P 500. Of course, the good times did not last. There was a whole bunch of macroeconomic turbulence in 1973, mainly caused by the oil embargo. This caused massive unemployment, massive inflation, and overall a very difficult period for the American economy. These extreme conditions sent the market tumbling down. Many of the names in the Nifty 50 ended up crashing between 60 and 90%. This crash happened in the span of about 2 years, and many names never returned to their previous all time highs. For many people, the story of the Nifty 50 is a story of oversimplification, of optimism taken too far, and the devastating consequences that that combination can have. Personally, I think investors are better off taking another lesson from this story, though, and that is that quality trumps everything over the long term. Let me explain. Jeremy Siegel is a renowned finance professor, and in 1998, he wrote a paper studying the aftermath of the Nifty 50. His conclusion was highly surprising. In his introduction, he writes, after the 1973 and 1974 bear market slashed the value of most of the Nifty 50, many investors vowed never again to pay over 30 times earnings for a stock. And then he asked the question, is the conventional wisdom justified that the bull market of the early 1970s markedly overvalued these stocks? Or is it possible that investors were right to predict that the growth of these firms would eventually justify their lofty prices? In other words, what premium should an investor pay for large, well-established, blue-chip growth stocks? The really cool thing here is that this study went on in 1998, which is almost 30 years after the crash of the Nifty 50. And what Siegel was able to do is rank every single stock in the Nifty 50 according to their annualized returns for the next 30 years. At the very top of the list, you can see companies like Philip Morris and Pfizer that were able to average 18% returns over 25 years. Now, for each of these companies, he recorded the actual PE ratio for the company in 1972, and then he compared it to the warranted PE ratio. What this metric here represents, the warranted PE ratio, is the amount that you could have paid in order to have returns that matched the S&P 500. So looking at Philip Morris, for example, the actual PE ratio in 1972 was a 24, but you could have paid up to 68.5 of a PE ratio and still done better than the S&P 500 just because the earnings per share growth was so high, almost 18%. And just notice here how closely the EPS growth matches the annualized return of the stock. This is why people say that over the long term, the performance of the stock will closely match the fundamentals of the company. The very interesting thing Siegel found going down this list is that for a lot of these companies, the warranted PE ratio is a lot higher than the actual PE ratio. For example, even Coca-Cola, a company that was considered very expensive back in the day with a actual PE of 46, well, you could have paid 82 PE ratio for this company and still beat the S&P 500. Of course, the more you go down the list and the more the warranted PE ratio decreases because the intrinsic returns are lower. And then when you get to the bottom of the pack, you can see that in many cases, the actual PE ratio is a lot higher than the warranted PE ratio. So according to these results, investors were paying too high of a price for these companies and too low of a price for these companies. But what if you diversified and bought the Nifty 50 as a basket, as a whole? Well, in this case, the basket that you bought was only overvalued for about 2 years in this entire period of time. And when you look at the level of overvaluation, it was less than 10%. So not all that much. You only lagged the market by 6-7% per year if you bought in 1972 or 1973. The surprising thing that he found is that if you had bought the Nifty 50 as a basket at any other time in this period, then you would have outperformed the market by a wide margin. If you had bought in 1980, for example, you would have beat the market by 27% per year over the next few years. In his conclusion, Siegel writes, you can find two possible explanations for what happened. The first is that a mania did sweep these stocks, sending them to levels that were totally unjustified on the basis of prospective earnings. The second explanation is that, on the whole, the Nifty 50 were in fact properly valued at the peak, but a loss of confidence by investors sent them to dramatically undervalued levels. The three main lessons he thought investors could learn was that 1. You must pay for growth. Good growth stocks, like good wines, are often worth the price you have to pay. The second lesson is don't pay any price. Among the basket of the Nifty 50 growth stocks, those with the lower price earnings ratios tended to outperform those with higher price to earnings ratios. In other words, don't be scared off by high absolute PE ratios. If a company has a PE ratio of 20 to 30, which is considered high, that doesn't mean you should completely disregard it. but try to cull out those growth stocks with lower price to earnings ratios. In other words, don't be afraid to pay 20, 30, or 40 as a PE ratio for a high quality company, but try to avoid paying 80 or 90 or 100. The third lesson is be diversified among various growth stocks and groups. Among the many gems were bad apples, even whole industries like technology. Diversification is a key to cutting risks and maintaining returns. Now, another 25 years have passed since Jeremy Siegel posted his paper on the Nifty 50 aftermath. And a few months ago, Monish Pabrai appeared on a really interesting interview at the Value Investors podcast. And in this interview, he highlighted some very interesting ideas about the Nifty 50.
If we go back to the early 1970s, right, and the early 1970s, there was this concept, late 60s, early 70s, there was this concept of the Nifty 50. And basically, the idea was you bought these 50 happening blue chip stocks, 2% into each one, and you didn't really care what the valuations were or anything. You just bought them all and you kept them, ignore all the noise. Now, what happened in 73, 74 is that was a crash in slow motion. It was a pretty big market correction when you look at the peak of 73 to the bottom of 74. The Nifty 50 got taken out back and shot. It was a bloodbath. And by 1975, nobody would admit they were invested in the Nifty 50. Now, there's some controversy whether Walmart was part of that Nifty 50 or not. Some people think that Walmart had its IPO in 1970. Some people think that Walmart was one of the Nifty 50. Now, just to make my case easier, we're going to assume Walmart was part of the Nifty 50. So let's say you invested in the Nifty 50, you put $100,000 into the Nifty 50, and 2,000 of the $100,000 went into Walmart, one of 50 bets. Now, let's also assume all the other 49 holdings go to zero. Now, there were some real losers in there, like Xerox and Polaroid and Kodak and IBM, etc., which actually IBM didn't go to zero, but some of the other guys did go to zero. But there was also ADP and Coke and Amex and Disney and all of these companies in there. I'm taking everything to zero except Walmart. So you have $2,000 that you put in. If you kept it invested for the last 55 years, with 98% of the portfolio going to zero, your annualized returns are almost 15% a year. And you blew out the S&P 500 with a 98% error rate. Okay, now to do that, one is you needed to recognize that Walmart was a beautiful wife, and no mistress was better than this beautiful wife. And you had to hang on to it. Okay. And of course, in 1975, when the bloodbath took place, everybody exited everything.
What Monish Pabrai correctly points out in this interview is that whether you did well by investing in the Nifty 50 completely depends on your time horizon. If you check your money 5 years down the line, there's a good chance that you lost half of it, right? And at that point, it would be seen as a horrible investment, a complete failure. But investors who diversified and were able to hold on to these companies for 50 years did extremely well. They had amazing results. Out of that basket of 50 stocks, yes, you had some duds, some companies that went to zero. And sure, you were down on your investment as a whole for a few years. You were momentarily in the red because you paid too expensive of a price. But over time, the growth in earnings, the quality of the companies you bought was much more important to the final result. But over time, the quality of the company, the fundamentals, the earnings growth, that was much more important than the initial price that you paid. And that, my friends, is a lesson worth writing down. That's it for this video, and I'll see you in the next one.